There we go. Sorry about that. Welcome, everyone, to the Anderson Report. This is game two of a Friday doubleheader. We're going to talk about the wild action in the stock market today. Not just today, but all week, frankly, which began with the S&P and the Dow making uh, all-time highs on Monday and Tuesday, taking that to kind of an extreme level on Wednesday. Um, and then, of course, we had the 3 to 5% correction, 3% for the Dow, 3.5% for the S&P, close to 5% for the Nasdaq correction on Thursday. Uh, Pretty much a long overdue correction. Rick, good afternoon. Thank you for joining the program. Our friend Rick Brandon is in the house tonight. Um, but we have talked on numerous occasions about the overbought condition and the just rally, really the runaway rally that was going on in the mega cap growth names, the mega cap tech names, particularly the stocks that have been driving the internet traffic trade. And there's just unquestionable that this rally had gotten very overextended. I really don't want to use the term bubble because that conjures up the internet bubble from 20 years ago that went really from 1998 to early 2000, and before the Nasdaq really lost 80% of its value. From the spring of 2000 to the fall of 2022, it was a very ugly 30 months for the Nasdaq Composite, and a lot of other stocks, um, other than just Nasdaq tech stocks at that point in time. It was a 2.5 year bear market, but um, there's no doubt that even though we were not in a full blown bubble comparable to what the internet stocks and the .com craze had produced from 1998 to 2000, or what was going on with the mortgage market, some of the finance companies, the mortgage um, securities markets in John. Yes, we are. Thank you for joining us again. Uh, in the that led into the global financial crisis, 08, 09. There's no doubt that the stocks were ahead of themselves. They were just had runs to the upside that could not be sustained, and the pace of which could not be really justified. And I think we're getting a little bit more light as the week went on as to what may have caused some of that. Wall Street Journal has a very interesting story about SoftBank, which is the big call it not really just a private equity. They're a large investment firm in Japan run by a guy who's a real um, renegade type guy. They were famously behind WeWork, the driving force behind the WeWork company, financed it through multiple stages of its growth until the market alerted, and then it was kind of discovered, or it came to light, the what really had been obvious to a lot of people, that the guy running WeWork was just an irresponsible person that never really should have been in a senior executive role of any company that size or any company one tenth of that size. And he kind of just uh, was clearly responsible for a lot of its growth, but that came with a lot of excesses that were going on at the company. I'm not going to say there was illegal activity involved, but it was certainly activity that very few, probably no responsible board of directors at any public company would have tolerated. And he was the prime reason why the company had to pull its IPO. SoftBank walked away from its financing commitments, and the WeWork is in, one or two stages beyond that of some type of financial distress. You'll just have to bear with the Diet Coke a little bit. After being away for 4 days, I spent probably about 12 hours on the phone with a large assortment of people today, catching up on a number of things, and combined with uh, uh, not a lot of sleep last night, and doing the show at 5 o'clock p.m. an hour, 2 hours ago. My voice is a little parched, but we'll get through it, and we'll talk about some interesting stuff and maybe show some interesting stuff. So, uh, SoftBank apparently, according to the Wall Street Journal, so it's kind of like Rolling Stone. If you read it in the Wall Street Journal, it's got to be true, right? Well, I would say probably 80% of it is. I'm an avid reader of the journal. Occasionally, they have stuff in there that's maybe not really as accurate as most of their stuff, but um, it's pretty much a must read. Um, SoftBank apparently had been a buyer of $50 billion worth of individual tech stocks, heavily concentrated in the mega cap, mega growth tech sector. The stocks, you all know the names of them, from Nvidia to Google to Tesla to Apple to Microsoft to Facebook, all the stocks that have been driving the internet traffic trade. Not only did SoftBank buy $50 billion of individual tech stocks, they also bought maybe $5 billion notional of options betting on the potential increase in those tech stocks. So that might have really fueled maybe the final push in this exaggerated move to the upside that culminated with the closing, uh, stock price closings on Wednesday before we had the Thursday decline. And I was not in front of my computer on Thursday, but I was watching the market occasionally on my cell phone, uh, or my computer away from the computer, as we like to call it. And yes, the high was on the Nasdaq closed at 12,056 on Wednesday. It had even the S&P on Wednesday, even the S&P on at 3580, an increase that day of 55 points. To say that it was frothy is probably an understatement. So, Thursday, we start out lower. We go lower most of the day, although the stocks did not close at their absolute lows of the day. The lows were put in probably around 2:30 ish, give or take 15 minutes. And then you had a little bit, not that much, but a little bit of a bounce at the end of the day. Just as an example, at the lows of the day on Thursday, the Dow Jones Industrial Average was down over 1,000 points. It closed the day down 807 points. So it got back between 200 and 250 points. The Dow was down 2.8% on Thursday. The S&P 500 lost 3.5% on Thursday. That's 125 points. Uh, but it was still at 34.55 after that big move up it had of probably about 1.75% on Wednesday. So it lost twice what it gained on Wednesday. The NASDAQ composite lost just shy of 600 points Thursday. It closed at 11,460, down 5%. Down 5%. Just a touch shy. Down 4.95%. We'll call it 5%. The Russell 2000 lost 3%, 1544. We had said numerous times that watch the Russell closely as it gets closer and closer to 1600. I'm just going to glance at my charts on occasion to add to the content of what we're talking about here. So the Russell 2000 closed at 1592 on Wednesday. That was higher than any of its closes in early August. It was the highest close it had had since February 25th, which was maybe the second day of the decline after the COVID outbreaks became a big concern globally. And we'd said numerous times, watch 1600 as a resistance level for the Russell 2000. Wow. It got to within 8 points of 1600. That was its close, 1592 on Wednesday. Down 3% on Thursday. Down maybe close to 3% at one point today. Closed only down about 0.5%. Now, the breadth of the market on Thursday for a day when the Nasdaq was down 5%, the Dow was down almost 3%, the S&P was down 3.5%. I would have guessed that the advanced declines were negative by 7 or 8 to 1. They could, on a day like that, it could be 10 to 1. But and on a really, really, really sharp, on some of the worst days in March, and even one of the days in June, you have what they call a 90% down volume day, where you can get total volume. You have up volume and down volume. And if down volume is 90% of total volume, that is viewed as a very sharp decline that occasionally creates, in a perfect world, if you get two 90% down days on volume in a row, that creates an extremely extremely oversold buying signal that really a lot of technicians, even market strategists, uh, like to use as a signal that the market's been oversold. Now, there are a lot of conditions that the market was overbought. There was stories early in the week that the put call ratio was the lowest it had been. The short interest ratio was the lowest it had been in 15 years. The short interest means how much stock is short in the market. As an example, as a indication of people making bets on the downside. So if you have a lot of short interest in the market, outstanding short positions, uh, then that means on a sharp decline, you're going to have buying activity because all those shorts eventually have to be covered. And in a sharp decline, that will help buffer the extent to which market averages go down because you will have buyers covering their shorts, taking some profits on the way down. And that adds another layer of buying to the market. When you don't, when you have very, very low levels of short interest, that means you have that much less potential buying on the way down from people who have short positions, and that the sell off on the way down could become maybe even a little bit more exaggerated. Well, advanced declines on Thursday, I was very surprised because we had decliners beating advancers by 4-1 at both the NYSE and the Nasdaq. I would have thought it would have been 6-1 or 8-1. Um, Infotech was the largest decliner, down 5.8%. Uh, on Thursday, financials were down 1.5%. Still a pretty, definitely a meaningful decline, but financials held up better than other stocks. And of course, it makes sense because financials had not had a big rally, have been trailing the market, underperforming on the way up. So then when the market gets hit on the way down, they're probably not going to go down as much. So not only did the advanced decline stats not show like a total bloodbath in the market, but the up volume, down volume wasn't 5-1, wasn't even 4-1. It could have been 6 or 7-1 on a day like Thursday. It was really just less than 3-1. You had 1.3 billion shares uh, um, up, and you had 3.65 billion shares representing stocks that were down. Now, basically, what that means is, look, if a stock traded, however many billion shares it traded that day, however many hundreds of million shares it traded, and it was up, that's up volume. If it was down, that's down volume. But you can have days in the worst of the decline. So that's really just down volume, really being just 70% of, am I doing that math right? 70% of total volume. If total volume was 5 billion and down volume was 3.6, maybe 72% of total volume. You had days in March uh, where down volume was over 90% of total volume. So this wasn't the bloodbath that we saw. It was, for people that were long, for people who had the idea that there was just, no end in sight to the rally. Yes, it could have been a painful day. But, I think that for people that have some experience in the market, some realistic expectations about how long stocks can continue to go up at that steep of an incline. Look, a lot of people have been looking for this day, and I think there were two tell signals that something was amiss with the big rallies, even the advances that we had on Monday, Tuesday, Wednesday. And that was that on Monday, the VIX went up. On Tuesday, the VIX went up. On Wednesday, the VIX went up. On a day when the S&P rallied over 1.5%, the VIX traded higher. The VIX typically trades higher when the market goes down and trades lower when the market goes up. The VIX is a volatility contract, but really it's a hedge. It's basically a bet that the stocks are going to get volatile to the downside. Okay, so The VIX went up Monday, Tuesday, Wednesday. The market went up Monday, Tuesday, Wednesday. Very seldom does that happen. And the other thing that was really struck me was that on Tuesday, uh, after I don't want to get this right before I say it wrong. Zoom Media reported their earnings early in the week. Okay, so they reported their earnings on Monday night. Yes, or Tuesday morning. It doesn't really matter. On Tuesday, okay, so Zoom is a stock. Everybody, Zoom is one of these stocks that people are using for conference calls, etc., etc., etc. The stock was $70 in late January. Okay, so the stock is up 300%. It was $299 on August 28th. On August 29th, it rallied to $325 in anticipation. That's almost a 10% increase. That's $25 on a $300 base. That's almost a 10% increase in anticipation of their earnings after the close. They report their earnings after the close, and Zoom goes up. A stock that's already up 300% on the year goes up 40% on Tuesday. Zoom Media rallied 40% on Tuesday after their earnings and had already been up. It had already been up 300% from where it was in January. I think that some people after that said, you know what? Enough is enough. This is just too much. Eh, this is just not right. It doesn't, it's stocks just don't act like this. Um, Now the market didn't sell off Tuesday. It didn't sell off Wednesday. Hey Neil, but to me, that Zoom Media price action on Tuesday after their earnings, where it went up 40% in one day after being $325 up from $70 in January, was just really a sign that we're just way overextended. A lot of these things are just in la la land. Um, Now, the one other thing, not specific to this sell off, the one other thing that's been bothering me about the market that I think is a negative sign is all these companies that are going public by a reverse merger with a SPAC, what is called a special purpose acquisition company. Uh, I think five electronic vehicle companies from Nikola and four others, I don't know the names of them all off the top of my head, have gone public through a reverse merger with a SPAC. Now, a special purpose acquisition company is a company that a well-known, successful investors with a proven track record will raise money, but basically tell all their investors, um, look, I'm a really smart guy. I've got a great track record. I've made a lot of money over the last 15, 20, 25, 30 years, however long I've been managing money. I've been very successful. You've invested with me numerous times in the past, and it's worked out well. Uh, and I'm going to raise $2 billion in a special purpose acquisition company, but I don't really know what I'm going to do with the money yet. I just am going to have this war chest where I'm going to sit with it. And then when a compelling opportunity comes along, uh, I'm going to invest in it with this money. And the only catch is when they do this capital raise in the form of a SPAC, and they usually become listed companies. Frankly, to me, it's just a sign that the market's just kind of searching a little bit too hard. Um, it, it, the fact that the fact that people would even put money into these, they're basically just doing a faith walk with whoever name is on the door. Okay, so you got these special purpose acquisition companies. You have to invest the money within 2 years. If 2 years goes by and you don't invest the money and all you've been using the money for is paying yourself a salary, paying some office expenses, et cetera, et cetera, maybe having a couple of research people research potential deals, then they say, okay, look, enough. 2 years, you haven't invested the money. The money's got to go back to the original investors, and the SPAC will get dissolved. Okay. Now, 5 electronic vehicle companies have gone public by doing what they call a reverse merger, being bought by a SPAC. And then the name of the company is, for instance, Nikola Motors, which is the guy who's allegedly some wonderkind kid. I'll call him a kid. He's probably in his early 30s. Who has this idea that he's going to make electric trucks. Okay. He hasn't produced one yet. He doesn't have a prototype vehicle. He's got some models, maybe, he's got some fancy video PowerPoint presentations. But he's got no sales, no earnings. Well, he's got no earnings, he's got no sales, and he hasn't even produced anything yet. So 5 of these electronic vehicle companies have gone public through merging with a SPAC. They call it a reverse merger because the SPAC buys the company or buys a controlling interest in the company. But then the name becomes like Nikola Motors used to be a SPAC. Okay. So none of these companies would ever, in their wildest dreams, be able to go public and raise money in the IPO market the traditional way. They don't have any revenue. They don't, I'll start from the bottom up on the income statement. They don't have any earnings. They don't have any revenue. They don't have any sales. They don't even have a cost of goods produced because most of them haven't even produced anything yet. It's just a concept. So the more I see this going on, the more I say, this just isn't going to end well. I don't care how strong the track record is of the people that raise this initial money in the SPAC. The companies that they're buying have zero track record. And in a lot of instances, the people running those companies, they have a concept. But look, I mean, there's only one Elon Musk. Okay. And he didn't go public via a SPAC. So that's been bothering me about the market. And there's no doubt that the market's been extended, highly extended, and early this week, ridiculously extended to the upside. So we had the big sell-off on Thursday. The internals weren't that bad. So then we come to Friday. Now, so we had a mixed opening. The Dow was up 150 points. The S&P was up 12, 18 points early. NASDAQ was down. Still a lot of overhang. Even though DocuSign had very good earnings, they sold it right out of the chute. It was down all day long. basically in the cloud space. A lot of high flying names in the cloud space probably took the hardest hit, even among the mega cap, mega growth names in tech. And I think the other thing that fed into this maybe created a little bit of like kind of a wake up call that fed into this tech sell off was the story that was going around on Thursday and also today that the Department of Justice will be filing uh, an antitrust case against Google sometime in the not too distant future. I would think that by the way the story read, you're talking within a couple of weeks. Maybe it's a little bit longer than that. But within a couple of weeks, Rick, I know that Bill Ackman raised a bunch of money in a SPAC. A number of these guys that have histories maybe of being very, very successful with their hedge funds have raised money in a SPAC. Who would put money into them? I mean, a lot of people who have invested with um, successful investors in the past put money into them kind of on the idea that, look, maybe this guy hits a home run and it becomes a 5 bagger or a 10 bagger. Or worst case scenario is, you know, I'm investing 250 million in this, and that's you know, 2% of all of my assets under management or something like that. So I think the investors are looking at playing a risk return game where, you know, what if it's the next Amazon or the next Tesla or the next Zoom Media or something like that? Um, but I don't think they can veto. I don't think they have voting rights on when um, the guy running the SPAC says, I'm going to buy this next electric vehicle company concept, that I don't think it can be voted down. It could maybe be voted down by the board of directors of the SPAC. But if you're just an investor, hedge funds main. Yeah, Neil's got a good comment there, Rick, if you can see it. Most notable hedge funds are the main issuers, like Bill Ackman's company. But, you know, Citadel is the only one that gets allocated SPACs. Well, uh, Neil, they could be big investors in a few of them. I don't know if they can. I don't know if they can be the DMM in in a company that they're a major investor in or not. But that's a little inside the baseball NYSE uh, banter. Um, so anyway, today markets then faded after the opening. By 11:30, we were down hard. The Dow was down close to 700 points. Nasdaq was down another 5%. The Russell was down another 3%. Um, the Russell got intraday right to its 50-day moving average. The a number of other indices got right to their 50-day moving average. The very popular cloud computing ETF CLOU retraced 15% from where it was Wednesday, from its high Wednesday to its low today. It went down from 26 to 22. This is the ETF that has Salesforce, Zoom, DocuSign, all the cloud media companies, but not Amazon, interestingly, because it would just dwarf all the other components in the ETF. So then the market stabilized a little bit. The Nasdaq at one point in time was down from its highs on from where it closed on Wednesday above 12,000, was down 9.8%. That was at the intraday lows today. Now, of course, we only really like to look at intraday lows on the chart if you have a big reversal day. You can't really say that today was a big reversal day because we didn't go from down to up. Uh, I mean, the Nasdaq lost 1.3% today. It was almost even at one point. The S&P lost 0.8%. It might have got briefly in the green around 3 o'clock, 3:15. The Dow did go green for a while late in the day, still lost 0.6%. That was after the Dow was down 650 points, maybe a little bit more. It rallied all the way back to where it was up a little bit, then faded, lost 160 points. So the Dow was down 0.6% today. The S&P was down 0.8% today. The Nasdaq was down 1.3%. The Russell 2000 down 0.6%. For the week, it tells you how strong the market was Monday, Tuesday, Wednesday. You have Monday, Tuesday, Wednesday up. Wednesday was a sharp up, almost a kind of a blow off top. And then Thursday down hard. Today, down hard intraday with a bounce. Next week, we'll see. But the advanced declines today weren't that bad either. There were only 3-2 negative. We had 3 stocks declining for every 2 that advanced, both on the NASDAQ and the NYSE. Year to date, the Dow is down 1.4%. The S&P 500 is up 6%. The NASDAQ is up 26%. It was up 33% earlier in the week. And the Russell's down 8%. So, for the week, the Dow lost just less than 2%. S&P a little bit over 2%. NASDAQ lost 3.7%. It had the most to lose. It's had the strongest gains. And the up volume, down volume today at the New York Stock Exchange was pretty even. 2.1 billion up, 2.3 billion down. Crude oil was down. They're going to sell everything on days like Thursday and Friday. Crude oil closed at $39.55. Gas is really cheap, certainly cheap on the East Coast. Couple of sectors that hung in there. The financials down today, only 0.3%. The materials only down 1%. Again, the stocks that really got clobbered, Infotech down 4.0% after a 5% decline yesterday, and communication services down 3.3%. So where does this leave us? Well, I think we've shaken out some of the excesses in the market. I think that there could be more selling, but I think that the more interesting dynamic will be the rotation that takes place within the equity space of the market, and whether or not the financials, which acted, a lot of the big banks were up today. And it'll be very fascinating to see if we get serious rotation into another potentially big sector of the market that can take some of the leadership responsibilities that might fall away from the mega growth tech names. So you had financials do quite well today and not yesterday, although some of the financials were doing well yesterday until the selling just kind of overtook everything, but they didn't really get clobbered yesterday. Financials were down 1.5% yesterday, as I mentioned. They were down 0.3% today, and a lot of the big banks and some of the regional banks were green on the day. Energy was down maybe 0.75%, even though oil traded below 40. It held up a lot better than the commodity, which is the opposite of what we saw for most of August when the commodity kept going down. when the commodity was rallying and energy stocks were going down. Uh, and the industrials and the materials, major, both major sectors of two of the 11 primary sectors of the S&P. Industrials down 0.6%, materials down 1%. They both look like they're consolidating gains that they've had for the last 6 weeks. And I don't really expect um, the selling there to build on itself. I think there were some people that were um, buying tech at or near uh, the lows today. Um, and it's always one of those things where there's a lot of people that say a little bit more individuals than money managers or hedge fund managers. Although a lot of hedge fund managers are very emotional also, and they will trade sometimes the way they will make mistakes like everyone, and they will make emotional sales that they regret, and they will not sell things that they wish they had sold because even though they think the price is crazy, they think maybe it's still got another 10% in it, and they'll only sell when the selling's already started. Uh, Not a lot of hedge fund managers, some, but not that many when things get really, really euphoric, really have the discipline and can separate the emotion from the technical and fundamental reality to just keep selling into ridiculous strength. So a lot of people will say, "Oh boy, I missed the rally. I missed the rally in the tech names. I missed the rally in all these stocks these mega cap growth stocks. I just wish we'd get a 10% correction and then I'll buy some." Well, I wonder how many of them really bought stocks today during that hour and a half to 2 hour stretch when we were kind of at our lows to the day when the Nasdaq was not quite getting there, but within a few 3 or 4% of its 50-day moving average, when it was close to having a 10% correction from its highs on Wednesday. And then, of course, you had a little bit of a wild card. I think it was almost, given that you had these stories going around quite a bit about how uh, you had the lowest short interest in 15 years, and you had a market that was down hard after a very positive employment report. Um, and I'm not going to get into it right now. I spoke about that at 5 o'clock. If you want to watch my replay, I did a pretty deep dive toward the end of my 5 o'clock show on all the positives that were in the August jobs report and all the positives that were in the August ISM manufacturing report from earlier in the week. We had a lot of economic data this week. Almost all of it was positive. A lot of it even more positive than um, the raw headlines. So um, we had this sharp sell off. We also had some selling in bonds, I think, really after the jobs report. The 10-year went out above 0.72. It was there about a week and a half ago. Then it went down to 0.6667, back up above 0.7. I think that's positive. I think it's a sign that the economy is strong and having a strong rebound. And I just think that even though the market was ahead of itself, there's no doubt about it. Okay. The tech space was the most glaring example of that. The economy is going to catch up to the market. And I think the fact that the economy is going to continue to show improvement will prevent the selling, the heavy selling that we saw. And actually, even though there were big declines on Thursday, volumes were not that much. I mean, the volume at the NYSE was 5 billion shares. The volume for NYSE stocks was 5 billion shares on Thursday. I think it was 4.5 billion today. So it's not like this was a heavy volume sell off, but I think it was a well deserved sell off for largely concentrated in sectors that were just wildly overextended. Um, so the bond just above the 10-year note, just above 0.7%, 0.72. I think it's still playing off things that Fed Chairman Powell said a week and a half ago at his Jackson Hole speech, which wasn't really at Jackson Hole, it was virtual. But he basically said he's going to let inflation run hot, and they're probably going to let it be above 2% for at least a quarter, maybe even a couple of quarters, until they even start to talk about raising interest rates. Now that doesn't mean that um, that that bond yields can't go higher. And I think one of the positive stories behind financials is that as the economy improves and as inflation starts to get a little bit above 2%, the Fed is not going to look to tap the brakes as soon as they see that. And that means that the yield curve can steepen because they're going to keep short rates just above zero. The yield curve can steepen because the 10-year note, maybe it'll go to 0.8, maybe it'll go to 0.9, maybe it'll go to 1%. I'm not worried about that. I think that 1% is still historically such a low rate that that's not going to impinge the businesses that have legitimately sound and solid business models. And that will steepen the yield curve. The banks will like it. So, we're going into a long weekend. That was the other thing. I, it was a little impressive and a little out of character for the market to rebound so sharply. Now, some people would say, well, a lot of shorts covered before the weekend because we're going into a 3-day weekend. But that's not consistent with the fact that uh, short interest was at a 15-year low coming into this 2-day sell off. So if a lot of shorts covered, where do those shorts come from? I'm sure there were some, okay? But to have the market rebound as sharply as it did during the afternoon, going into a 3-day weekend, I think this was like a lot of bargain hunting from from maybe like vanilla traditional money managers. I think there was a lot of selling, maybe a little puking by some very inexperienced Robinhood traders, and maybe some hedge funds that were just a little bit too full of them, a little bit too full of themselves, or a little bit too giddy with long positions that they've been trying to juice maybe a little bit over the last few weeks, and in retrospect, this SoftBank story that they had bought $50 billion worth of, mega cap, high powered growth names in the tech space, and also loaded up on about uh, $3 to $5 billion notional worth of option contracts in the space. Also, I can't wait to see further stories and disclosures from SoftBank as to were they selling the last couple of days? Had they bought those positions in August? Maybe from mid July through the end of August? Had they bought them just over the last few weeks? Had they not really sold much until Thursday and then they got caught long into a sharp decline? Um, that's going to be a very fascinating story because the guy that runs SoftBank, his name escapes me right now, a little bit of a renegade type guy, likes controversial uh, CEOs and business plans. Kind of he likes things that are transformational. I think that's why he was so enamored with the guy who was running WeWork for a while. Um, but that I think this SoftBank story is it. It's going to be. This is one of these stories that there's going to be a second chapter, a third chapter, a fourth chapter. Um, there's going to be more about this, and it's going to be a very interesting read. All right, look, it's Friday going into a long weekend. It's 7:52. I appreciate everyone's support. If you have not subscribed yet, please hit the subscribe button on YouTube. This is my YouTube channel, The Anderson Report. Hit the little bell next to it to get notifications of the next broadcast. The next broadcast is probably going to be either Sunday or Monday. Obviously, the markets will not be open Monday. Maddie, thank you so much for your support and watching the program. And the next broadcast is probably going to be either Sunday or Monday, probably Monday before the market reopens again on Tuesday. It's The Anderson Report on YouTube. It's TJ Anderson 12 on Periscope. My Twitter handle is TJ Anderson 1. Newsreader, you guys have been great. Thank you so much. And everyone, have a great Labor Day weekend. Be safe and enjoy.